My number one stock recently crashed on the announcement of an acquisition of a great consumer brand. And that's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and if you're in the know, drop a meow in the chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this is a very interesting one because how often do companies announce acquisitions of great consumer brands and then the share price tanks? The only situation that really happens is if the market believes that they're paying too much, and that might be the case here. And so let's get into the details here and I'll walk you through this because I actually still think this company is a pretty interesting and unique opportunity, and it's up there on our Patreon tracker list. And so you can see here, Vista Outdoor traded under $27 per share today, which is down from $30 per share, which it was trading recently. And of course, that's even lower because the share price continues to go down in this environment where people are less and less optimistic towards sort of like outdoor products companies. And you can see that point right here where year to date, they're actually down almost 50% or 43, 44%. So a very tough year for owners of this security. And this was a position that I actually bought last year in the summer. And so I actually had to use a cash secured put to buy it because I thought that there could be some additional downside risk as the consumer sort of slowed down a little bit. And so I've actually been using a lot of cash secured puts as of late. And so it really helped me in this situation because the shares are trading at $40 per share level. And I used a cash secured put, which gave me a net purchase price of somewhere in the $30 per share level. So it really helped me in this situation, but I'm still in the L because the share price is now under $30 per share. But I think that there is a substantial opportunity here. And you can see what I mean by Vista is actually the number 2 cheapest to intrinsic value company in the tracker that the Patreons have access to. And I threw up Alibaba there because I always show you guys Alibaba. I never show you like who's really above it, but you can see that one of the 4 names that are cheaper than Alibaba is Vista Outdoor. And so yeah, it's number 2 on the list. And so what makes it number 2 on the list? Well, there's a huge opportunity here that you can't really see in the financial statements if you just look at the numbers. And this is why I always say it's important to not just value the companies on a numerical basis, but you also got to understand the qualitative because there could be a story that you're sort of like missing out on. And so what's the story that you're missing out on? Well, the company is actually separating, and they're going to separate their 2 segments in what's called a spinoff. And I believe that that's going to unlock a significant amount of value for the shareholders. Now, that's not the huge focus of this video, but I just wanted to show you that they have an outdoors product segment and a sporting product segment. The sporting product segment is basically like ammunition for weapons. And so when you split out the outdoor and the sporting, the idea is that because the whole company is looked at as an ammunitions or sort of like weapons manufacturer right now, it's taking a lower multiple in terms of like a valuation because it may not necessarily meet ESG requirements. And so some mutual funds may not necessarily be able to buy it. But once you separate those two, well, the outdoor products company will generally be able to claim a higher multiple because more companies should be able to buy it. So that's the theoretical approach here. And that's exactly what management is telling you. So you can see here, I have it highlighted where management is actually saying that the whole company today is trading at approximately 4 times trailing 12 months EBITDA. And they believe that the legacy business, the sporting products business, will continue to trade at around 4 to 5 times trailing 12 months EBITDA. However, the outdoor products business, which is a little bit of a smaller segment right now, but it should claim a higher multiple. So both companies should be worth approximately $3 billion each, as opposed to both segments being combined and only being worth around $3 billion today. And I just wanted to go a little bit deeper into the 2 segments because they do explain this in a lot of detail, and you can get this on their website with their latest investor presentation. That acquisition that they announced, which I will dive a little bit deeper into, is an acquisition in the outdoor product segment. And so you can see that there's like camping stuff, there's golf equipment or golf type equipment there. And then on the sporting side, you can see that, you know, they have brands of ammunition. The one that I recognize the most is the Remington one. And so you can see that they do believe that when they split up these two segments, they're going to be able to realize significant value. And just a little bit further explanation of the company, you can see in the sporting products brands, they have 3 brands which have $100 million of annual sales. That's their Federal, Remington, and CCI brand. Once again, I'm only really familiar with Remington. I think Federal might just be weapon or ammunition for police units and stuff. I'm not really sure, so don't quote me on that. I'm more familiar with their outdoor products brands, and that's kind of like what attracted me to the company in the first place last year when I bought into it. So you can see that they have large brands like Bushnell. If you're into golf, you might know what Bushnell is. They have Camp Chef. Like, I'm really into smoking, like smoking meats and stuff, and so they do have smokers. I did look at one of their smokers. I didn't end up buying one of their products, but Camp Chef is an important brand. It's definitely not high up there in terms of like smokers that are available, but they provide stuff that's pretty much at the same level as all the other companies do. And then Bell, I believe that that's a helmet manufacturer. I might be wrong there. And they also have some fast growing segments in the brands that aren't $100 million. Like, for example, Quiet Cat, they make sort of electric bikes. And so that's another brand that I'm really excited about. And so Fox, being sort of like an outdoors helmets manufacturer and clothing manufacturer, they fit really well into that outdoor products brand segment. And this is more of like a feel-good slide that any company would put that's selling outdoor gear. They're basically just saying that COVID accelerated an already increasing trend where more and more people are participating in outdoor sports. And I actually agree with that. I think a lot of us are trying to sort of like get away from our phones and our computers and, you know, go camping, biking, hunting, go to national parks, play outdoor sports, even play golf. My wife and I, we always talk about just getting out to the course more often than we normally do. And so I do agree that the culture is moving more towards sort of like outdoor leisure sports. And I think part of the reason why that's happening is because sort of like that whole Instagram lifestyle, people are like snapping their whole lives. Well, in order to snap your life, you kind of got to make it a little bit more interesting. And so I think that whole like social media sort of like showing lifestyle is forcing people to try new and unique things. This is why like 10 years ago, nobody ever talked about going on winery tours. Now it's almost like everybody's going on winery tours. So I'm kind of seeing that stuff happen too, which, I mean, it's not a bad byproduct that's causing people to go out and try new things. And so I really like it. I like the direction that it's going, where it's getting people out of the house. No more just watching Netflix all day. Like, get rid of that. It's summer. Get out of the house. And so you can see that the Fox brand very much fits into that sort of like outdoor lifestyle. So they have 3 subsegments. They have mountain biking, motocross, and sort of like lifestyle clothing. And so I think it's a great fit to the Vista outdoor portfolio. Now, one thing that I do want to mention is I've said this a couple of times on the channel, but not a lot. So previously, before COVID, I actually was a stand-up comic, and I performed all over sort of like Ontario. And one of the things that was really interesting is that anytime I went to Northern Ontario to perform, especially places like Thunder Bay or anywhere like very north, you saw a lot of people wearing Fox clothing. And so I think this is a bigger brand when it comes to like the more rural area. And I think that makes a lot of sense because those are the types of people, or that's the sort of demographic that has access to that excess land. They can go motorbiking or mountain biking or whatever. And so it makes a lot of sense that that was the area where I saw the brand being worn a lot. But it was actually interesting how much I saw the brand being worn out there. And so that was sort of like my experience to the sort of Fox brand. And a lot of you guys watching this video, you might have already been familiar with the brand, and you might say, hey, it's not just a rural thing. We also see it in the city. And so that would make a lot of sense to me as well. And so the question is, why is it that the market doesn't like this M&A? Is it because Vista is not good at buying companies? Well, I actually took a look at that, and I think that they're actually really good at buying companies. You can see here that they actually do have an M&A strategy. And all I really wanted to do was ensure that they have been performing M&A and they do have a strategy. And you know what? It looks like Vista actually is an M&A shop. And so it looks like in order for them to present a slide like this, it tells me that internally they have a whole M&A team that's focusing on multiple transactions all the time. And so the question is, how have they been doing with their M&A? Well, you can see that they have a good track record of buying and growing brands. So Remington they bought, they doubled the revenue. Heavy Shot they bought, they increased the revenue 10%. Quiet Cat, that's that EV bike company. They're on track to 3xing the revenue by fiscal year 2023. That's amazing. And then Foresight Sports, their revenue is 25% higher than the acquisition run rate, and they expect to achieve 125 million by fiscal year 2023. Now, I'm not saying that in itself suggests that they're good at M&A. Ultimately, over the long term, you got to watch that return on equity and that return on invested capital figure to sort of understand if they're really good at allocating capital. So that's something that I'll continue to watch. But I see enough evidence that this company is moving in the right direction. However, this is somewhat risky. And so from a qualitative perspective, although the quantitative makes sense because the valuation is so low relative to what I think the intrinsic value is, I think there is a qualitative risk here where will management actually reach the sort of like guidance that they're expecting to reach? And I think there's a bit of a risk there. And so we'll see how it plays out. But even if they only hit like 50% of the growth that they're expecting to achieve, I still think this company is relatively cheap. And so let's dive into the transaction a little bit more to see what the market really hated about it. Now you can see here, Vista actually paid approximately 10 times EBITDA, which was funded through debt. Now here's the thing. They did mention on an earlier slide that the average multiple for companies in the outdoor space is approximately 10 times EBITDA. And so if they're paying that for a strong consumer brand like Fox, it looks to me like they paid a reasonable price. But I think in this environment, the market might be looking for more bargain purchases, not 10 times EBITDA type purchases, which would be more of a normalized market. And that I would agree with. So they agreed to pay 540 billion with contingent incentives of up to 50 million, so a total of 590 million dollars. And the sales on that transaction are expected to be 350 million, while the EBIT on that transaction is expected to be 55 million. And so, of course, they're going to finance that transaction through a combination of their credit facility and a $350 million secured term loan. And the risk there is that we're in an environment where we have rising interest rates. And so if you're using sort of like a revolving credit facility, this transaction gets more and more expensive as time goes on. So I would really highly encourage them to lock in this debt as soon as they can. Or I think what they might do is they might actually use some of the proceeds that they get from the spinoff to sort of pay down some of this debt. I don't know how they're going to allocate those funds, or there might not actually even be any funds because they might actually just spin off shares and the company just goes off on its own. So there might not even be capital available. But I guess the point that I'm trying to make is they got to pay this debt down as soon as possible. I'm sure that they have a plan, but that is a risk with this transaction. And of course, the other risk is how much leverage does the company have overall? And especially in this environment, I'm looking for companies that have zero leverage or next to zero. And so that could potentially also be a risk here. And you can see in the middle of the page here, Vista Outdoor's leverage ratio is expected to be below 1.5 times, which is well within the target leverage ratio of 2. But like I say, I don't care what their target ratio is. I'm saying that there's additional risk to the balance sheet here as it was financed completely through debt. And it's even a higher amount of risk as we're in an environment right now where interest rates are being raised at crazy high levels. Like, for example, the Bank of Canada just announced a 100 basis point increase to the rate. And I do believe that the US Federal Reserve will do another 75 basis point increase. So this is not the environment to be playing with variable debt. But Vista will give us update guidance, and I hope they provide more information on the transaction. Now, I actually broke down the transaction, and I think it's a little bit rich in this environment, and let me dive into that for you. So this is the Fox transaction, and this is all the information that they gave us. So the cost of the transaction is approximately $590 million. There's going to be $590 million of new debt, which amounts to $10.35 per share in debt. When you work it through, I believe that this company will make approximately $30 million of net income every year. And so the purchase multiple to earnings is 21 times earnings. Now, I think that's a little bit high in this environment. The only way that I would use a 21 times multiple is if I expect to be able to increase Fox's net income over the short to medium term, which is what I absolutely believe that they think they can do. So you buy the company at 21 times earnings, but you know that you're going to double earnings over the next 5 years. So in effect, it's actually a bargain purchase for you. But for investors, especially in this environment, that's a let's see it before we believe it type of approach. So I can understand why investors have sort of like traded the security down for the price that they paid in this environment. And so what is the company actually worth? Well, I'm actually valuing the company still at $85 per share. And so how am I sort of building that up? So you can see that the EPS sum plus the terminal value gets me to an approximate valuation of just over $100 per share. And that's using a terminal multiple of only 12 times earnings. And I have a terminal discount rate of 11.5%. Obviously, I'm penalizing them for the amount of debt that they have on their balance sheet. So there's a $22 per share penalization to the valuation. So that brings it down to $85 per share. And so that compared to the current share price of $26 amounts to approximately 31% of its intrinsic value. So post-transaction, I still think that this company is relatively cheap. Now, the question is, I'm just one person looking through it with a very specific lens, and I could absolutely always be biased. So I like to check my work with what sort of like the analysts are seeing, because the big secret with analysts is don't pay attention to their buy or sell calls. I mean, you could pay attention to their sell calls, but with their buy calls, pay attention to how much of a gap there is between the current share price of the company and their target price. If there's a huge gap, it's really telling a big story. So what do they think? You can see that the analysts, all 7 of them have a buy or a strong buy. So that's a little bit telling, but analysts generally have buys on companies that they're covering. That's not a big deal. But the bigger deal is notice that their average share price is $56.83. So that's their average target price. So that's more than double the current share price. That's very telling. And so it tells you that they're not only bullish on the name by just having strong buys, the vast majority of the analysts have strong buys on this name, but they're bullish on this name from their target share price. And that's a 1-year target. So that's not even their like intrinsic value calculation. What they're doing is they're giving sort of like a 1-year target share price, and that's still double the current share price. So it's not just myself that's seeing value here. The analyst community is also seeing value. Now, if you want access to my model, you can get access to all the model, the tracker, and everything else at the lower tier of the Patreons. And if you want to join us for a live epic Zoom presentation every month where I save my very best work for, you can get access to that at the upper tier of the Patreon level. And like I always say, if there's any problems and you don't like it and it's not for you, let me know and I'll fully refund that first month subscription, no questions asked. Now, for the Patreons, here's something that you will see in the model. I actually put a question for Vista's sort of like revenue guidance, and I said, can they actually achieve this guidance? And what I'm really referring to is that I actually believe that there's a consumer-led recession that has already begun, and the official numbers aren't out yet. However, I sort of like read the tea leaves here in this video right here.